Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane. This week, we're covering investment strategies for young adults and children. We'll be covering this topic in greater detail at Spidell's Summer Tax Webinar, along with other retirement planning topics, Section 1031 exchanges, business tax credits, and more. For details, go to spidell.com and click Webinars. Planning for the next generation includes both estate and gift planning strategies, as well as helping the next generation get a financial head start. The younger a taxpayer begins investing, the greater the benefit they'll receive from compounding investment returns. Individuals who have maintained Section 529 accounts for at least 15 years can make a direct trustee-to-trustee rollover from the 529 plan to the beneficiary's Roth IRA, effective for distributions made after December 31st, 2023. The exclusion only applies to the amount contributed to the 529 plan and earnings on the contributions before the 5-year period ending on the date of the distribution. Rollovers from 529 plans to a taxpayer's Roth IRA count toward the taxpayer's annual IRA contribution limits, which are $7,000 for 2024 for taxpayers under age 50 and $8,000 for those age 50 or older. However, the Roth contribution AGI limitation does not apply to these rollovers. Rollovers from a 529 plan are subject to an aggregate lifetime limit of $35,000 per beneficiary. The greatest benefits of compound investment growth are realized when investing is done early and often. For young adults, especially teenagers, the most significant obstacle to investing in an IRA is a lack of earned income. But once the young person starts their first job, helping them contribute to a Roth IRA can give them a retirement investment head start. Due to a young worker's low tax bracket, Roth IRAs provide the greatest benefit. In fact, many teenagers and young adults who are dependents have earned income that does not exceed their standard deduction, and therefore they pay no federal income tax. Roth IRA distributions later in life will likely occur when they're in a federal tax bracket above 0%. Taxpayers who want to get an even earlier start on investing before their children or grandchildren have earned income can invest in taxable investments. Taxable investments don't have the same tax-deferred growth feature of IRAs, but the investments can still benefit from compound growth. The downfall of investment accounts for kids is that if earnings reach a fairly low threshold, which is $2,600 for 2024, the kiddie tax rules come into play. But before the threshold is reached, the child will benefit from what is most likely a very low or no tax rate. Taxpayers can limit kiddie tax by making investment decisions that will reduce a child's unearned income, including deferring capital gains to the following year or until the child is old enough that the kiddie tax rules no longer apply, deferring gifts of income-producing property until the child is old enough to not be subject to the kiddie tax rules, choosing tax-deferred investments such as U.S. savings bonds or certificates of deposit or treasury that won't mature in the current year. If the child has earned income, investing in a Roth IRA so the account appreciation is not taxable, and putting investment dollars into a 529 college savings account, which will grow tax-deferred, and the earnings will never be taxed if they're used for qualifying expenses. Get all the news you need to keep your clients current, as well as new tax planning strategies to minimize taxes throughout the year at Spidell's quarterly Federal Tax Update webinar. Sign up for all 4 topic-driven webinars or just a single session at spidell.com under webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.